Well, hi, everybody. I'm Ric Edelman. Thanks very much for joining us for today's conversation. This is a hot topic, and this is the right set of content that we're going to be providing for you today. How to secure a truly diversified crypto exposure. With Bitcoin ETFs getting all the attention over the past year and a half, I think everyone's beginning to realize there's a lot more to the world of crypto than just the Bitcoin allocation. So we're going to tackle this topic with two experts in the field. I'm very happy they're both going to be with us. We have Dave LaValle. He is the global head of ETFs at Grayscale, perhaps the largest ETF and asset management organization in the world of crypto. Dave's been in this field for a very long time and previously a senior member of the leadership team at State Street, one of the largest asset managers in the world. And also Andy Baehr. He is the head of product and research at CoinDesk Indices, which is one of the most influential organizations in the world of crypto, been engaged in this space in asset management, wealth management for a couple of decades now plus. So Andy, Dave, good to have both of you here with us today.
It's great to be here, Rick. Thank you.
Thank you, Rick.
Do me a favor, Dave, and go into a little bit more detail on Grayscale
Sure.
for those who somehow aren't as familiar with it as they might think.
Yeah, sure. Listen, Grayscale is the largest crypto asset manager in the world. Obviously, many know us for being a real pioneer in the industry, and having created a Bitcoin fund, over a decade ago, 12 years ago, which ultimately culminated in early January of us, uplisting our flagship product to become an ETF. We obviously led the charge, I think, is a fair statement, to bringing Bitcoin into an ETF realm. We also are, quite well known for a number of our private placement products, which are, over-the-counter traded, private funds that are quoted over the counter and can be, traded in the public markets for a number of different, maybe more nascent exposures. But we have a 40 Act ETF franchise. We obviously have Bitcoin and Ethereum ETFs, and we are 100% committed and dedicated to the crypto marketplace with good institutional quality infrastructure, compliance, and framework that meets investors wherever they are on their crypto journey, and then delivers them a regulated financial product that fits their needs. So it's great to talk about it here, and diversification is certainly a topic that has come up with our investors. So happy to chat today.
It's interesting that we're having you talk about this, because I don't think Grayscale gets the credit that it deserves in the fact that we've got these Bitcoin ETFs in the marketplace. Grayscale pioneered, of course, GBTC, the Grayscale Bitcoin Trust, way back. When was that? 17, 16?
Oh, no. That was 2013. Yeah.
13. Because I've been involved in crypto ever since. So I was a very, very early investor in GBTC, owned it forever.
Yeah.
And GBTC was the first, I'll say, easy way for the average individual to buy Bitcoin, and grew to be incredibly successful and massive in asset value. And then when you had the opportunity, Grayscale petitioned to turn GBTC into an ETF, and the SEC kept saying no. I half a dozen applications over the years, maybe more.
Yeah, it was a number of applications, but ultimately culminating in a denial in 2021 that we challenged. Yeah.
And so Grayscale went and filed the lawsuit to persuade a court to argue that Gary Gensler was wrong in his denial. And the court agreed with you. Our ruling, my favorite phrase, that the SEC had acted arbitrarily and capriciously in the denial. And if it were not for your lawsuit, we would not today have the Bitcoin ETFs, and we wouldn't have the incredible run up in asset flows into the ETFs that we've seen, the best performing ETFs in the industry by far. And Grayscale gets all the credit. And yet here we are saying, the premise of this conversation, there's more to crypto than just the Bitcoin ETFs. So the folks who started it all are the ones making that statement, and that's why we really need to be paying attention to this conversation. And I want to highlight you, Andy, as well. You've been in this field for so many decades, as we had mentioned. CoinDesk Indices, not a household name in the TradFi world. Most financial advisors, I think, are not terribly familiar with CoinDesk and CoinDesk Indices. So give us some further background information on the organization.
For sure, Rick. Thanks. And we agree that Grayscale was out and boldest, and we were delighted to ride along with them on that journey and in winning that momentous battle. CoinDesk is the most trusted voice in crypto. We have three big businesses. We have a thriving media business. We have a data and indices business, which began over 10 years ago, and we have an events business branded Consensus. So those are the most important crypto events in the world, and currently we have a number of them every year, the biggest ones in Hong Kong and in the United States. CoinDesk Indices oversees or underwrites over 40 billion in assets in many different types of wrappers, including asset management products, ETFs, and derivatives. We're building and building and building as fast as we can to meet the new needs of customers around the world. And we're very excited that Bitcoin has such a large footprint in the United States right now, because naturally people are going to start looking beyond it and see, as this conversation is focused, how they can actually apply their standard investment practices, their best practices for prudence and investment management in this new asset class. So we've been around for 10 years, kind of waiting for this moment to happen, when investors start to think about crypto the way they're thinking about traditional asset classes.
I want to do a little bit of a sidebar before we jump into the conversation of the day. You made a brief comment there that your biggest conference is actually in Hong Kong. The events you hold here in the US are mandatory, must go to events. I've been to most, I've spoken at several. They're a big deal. They're not just a way for people to learn what's going on, the latest and greatest in the field, but to really get a deep dive into who the players are, and the opportunity to network, connect, and advance your business is really second to none at these events. But the biggest aren't in the US?
No, no,
Hong
no.
Kong?
I misspoke, or my words came out wrong. I think our biggest events are still the North American events. I think that this past year was our inaugural Hong Kong conference, which was sold out and really brought together folks from all over the region. I'd like to say that in the last 3-4 years, there's been more of an institutional and a serious kind of tone to these conferences as the asset class becomes available to more and more people. And that's been great to see. We'd like to see the asset class maturing that way. But Hong Kong sold out for sure. We'll be back there next February. We'll be in Miami next March.
And that's kind of my point about Hong Kong, is that most people in the US, when I talk to them, either investors, consumers, or advisors, they often say, in the world subject about crypto is, why do we need it? What's the big deal? Our banking system works okay. And what they tend to forget is that this is a global asset, that has application and, frankly, fundamental need, often to a greater degree overseas than it does here in the US, where, frankly, our banking system does work okay. I mean, we love to hate banks, but it's not like it is in Venezuela, Argentina, Zimbabwe, et cetera. So talk about the Hong Kong reaction. Selling it out's one thing, but talk about the reaction you found globally of hosting a major event in the Far East.
I would say that we were delighted, but not surprised. I spent most of my traditional finance career on the sell side on derivatives desks. And one thing you start to learn is that investor appetites, especially for things like wrappers, are different in different regions. In Europe and Asia, there are much bigger structured product markets versus ETF markets here. There's a lot more sell side participation. In fact, that sell side institutional trading and derivatives kind of community within crypto is what got me interested in joining the business in the first place. So when you head out to Asia, you see a lot more trading desks, you see a lot more use of derivatives and structured products and those kind of wrappers. In fact, that prompted the regulators out in Hong Kong, the SFC, and in Singapore, the MAS, to actually, not that they were very fast at doing it, but they were a little bit more forward-looking about access to both institutions and retail for digital assets. So I find it sort of a good, refreshing reminder that these are global assets, that the US is starting to let them participate a little bit more in both the trading and the investing world. But they've definitely grown their legs all around the world. So it's a fun thing to deal with. And when you're used to how the global markets trade, it's actually quite natural.
And so this is why, as you go down that rabbit hole into discovery about crypto, you need to look at this with a global perspective, not merely what's happening here in the US. And I think that's a great illustration of that. So let's tackle this from the very top. And by the way, if you have questions, feel free to raise them. Go into the Q&A box here on Zoom and type in your questions. Several have already done that. Many of you submitted questions when you registered. I'll be hitting Dave and Andy with those questions as we go, and I'll be looking at the Q&A box to see what we can add to the conversation as well. So feel free to participate in this dialogue along with us. So Dave, beginning with the premise that Grayscale created GBTC, now with tens of billions of dollars of assets, converted it to a Bitcoin ETF. You've now got GBTC Mini, and yet your argument is there's more to crypto exposure than just that. So
Right.
Let me just begin with the initial question. What constitutes diversification in crypto? Let's begin there.
Well, what I would say as we're facing off with financial professionals and investors of all shapes and sizes, the initial conversation, especially as the inflection point of this Bitcoin ETF coming to market, was a real different conversation about whether crypto belongs in a client's portfolio or not. And so the vast majority of the past kind of 14, 15 months since the ETF has been in market has been talking about digital assets largely with a heavy predominant focus on Bitcoin and also Ethereum, because those are the two ETFs that are in market. And so once you kind of get over the hump of this concept of what Bitcoin is, what a digital asset is, where it fits in your portfolio, how to think about it as an asset allocation, the conversation then starts to shift from something that's less binary, yes or no to Bitcoin, to something that's more about portfolio construction. And when you start having conversations about portfolio construction with crypto, it very quickly shifts into, well, wait a minute, like where does this actually fit into my portfolio? And that, opens up, a real wide range of conversations dependent upon how the investor is actually, constructing that portfolio and where their desires are and all the other kind of, financial planning and portfolio construction, theses that exist. What's the time horizon of your investment? All these other kind of components that kind of are inputs to making a decision about building that asset allocation. And so you start saying, okay, well, where does digital assets fit into your portfolio? Okay, for Bitcoin, maybe it's a digital store of value, and so it's going to replace some gold. Well, maybe people think about crypto more generally as a disruptive technology, and therefore it should have the, kind of behavior or, the attitude, so to speak, of a small cap tech where there's kind of up into the right growth, higher risk, higher returns. And so depending upon how individuals are looking at that allocation and where that, crypto allocation should essentially fit into their portfolios, is that next step. And then the third step is, well, wait a minute, there's a lot more out there other than Bitcoin and Ethereum. And we say, yes, there are, which then leads to, wait a minute, there are millions of tokens out there, and now I'm totally overwhelmed, right? And that's something where I pause and I say, okay, let's just pause for a moment. A guy like me thinks about a token, and I think about going to an arcade as a kid and getting a roll of tokens and playing arcade games. And
you're showing your age.
Yeah, we have a quick chuckle about that. But then I always pause people and say, listen, when you hear token in crypto, replace that word with software. And the concept of there being millions of pieces of software out there is much more kind of settling and accepting by the average user of crypto or someone that's new to the space. And then you can have a conversation about the reality that there are, high quality pieces of software that are going to succeed and are going to compete. And then there are pieces of software that are going to fail. And that's really ultimately where we get to the real point, which is you need to partner with an expert and you need to make more sense out of this really expansive, brand new, nascent asset class. And so the principles of diversification are the same as they are in crypto, as they are in equities, but the access to high quality diversification with institutional grade and with ease of access is totally different. And that's really where we are right now in making sure that we're having a thoughtful approach to a somewhat complex asset class that is very nascent, that doesn't have all the tools available to everyday average investors. If somebody wanted to create a highly concentrated, but diversified portfolio of stocks, they have a lot of access to data and a lot of access to tools that they can kind of construct that on their own based upon their own needs. That just isn't there yet in crypto. And there is a tremendous desire for diversified exposure. But getting that diversified exposure in an efficient way is what I think is a really important thing to do, and to leverage indexes and to leverage ETFs and market that are going to be here pretty soon, I think.
Well, in fact, to that point, Andy, Dave just mentioned equities. Any parallels in crypto diversification to equity diversification?
Yeah, well, first I want to echo and Dave's comments that it's people, I think their hearts and heads are in the right place. They want to apply best practices to their investment portfolio, regardless of asset class. And I think, look, we've been in a past, my son, we were talking about our sons before we started. I have a son who's about to start college, and he's been the best investor in the house. Why? He was born in 2008, and he bought an index fund, and he smoked everybody, right? So there's living proof, basically. I don't tell him this, but it happens to be a true fact. That you would like to apply things like correlation analysis over a broad set. You'd like to look for a market portfolio. You'd like to find an efficient frontier. Everybody would like to do this, and however big they decide to allocate to crypto, they like to think of it as different asset classes and take advantage of those, right? Those free lunches, those diversification benefits. There's two problems with crypto that if you look at correlation coefficients, they're all pinned pretty high. I'll give you an example. For example, our CoinDesk 5 index, which really represents, top tier cryptos, market cap weighted, is very correlated, over about 0.9 correlated with our CoinDesk 80 index, which is really kind of a mid or small cap index. As I look today, CoinDesk 5 is up about 12, 13% on the year, and CoinDesk 80 is, up 17% on the year, and CoinDesk 80 is down 38%. Yet their correlation.
But you said,
0.9.
but you said they're almost identically correlated.
They're identically correlated. So correlations can be very deceiving. People will say all of crypto moves up and down the same way. Over the kind of periods where you'd measure a correlation coefficient, that may be true because it's an asset class where the liquidity tends to move around like a swimming pool on a cruise ship. It sort of swings around back and forth. Yet there is, over periods, trends that will make these performance characteristics very different. So it's difficult to apply these very standard sets of diversification metrics to crypto. The other point is, imagine trying to, to achieve correlation or achieve diversification benefit from an equity portfolio when you are only allowed to invest in one at a time every 6 months. Right? It takes a lot of patience, and you have to look around. What's my peer doing here? What's my advisor saying over there? There hasn't been any benchmark that reflects a proper diversified portfolio that goes beyond Bitcoin, that gives everybody a meeting place to decide what the current accessible market portfolio is. So I think it's been difficult. I think that actually is changing in this particular season that we're in right now, as more and more assets become available and as more and more standards develop themselves.
Yeah, I would. Can I piggyback on that for a minute, Rick? What I would say
Please.
is, I would sum that up. And I mean, Andy and I aren't going to disagree much. This isn't going to be much of a debate, Rick. We're going to be all rowing in the same direction. It's complex. The surface level information that is readily available to the average everyday investor, self-directed, or a more sophisticated financial professional who is managing clients' money, who is open to allocating to crypto, is not going to tell the actual story of how the market behaves. And so we have this wonderful opportunity to, utilize a trusted wrapper in the form of an ETF, and, utilize what people totally understand at this point in time about market cap weighting, and utilizing indexes that people are quick to say are passive in nature, when we would all agree are not totally passive, just set it and forget it. They have the opportunity to ensure that investors are going to be at the forefront of what continues to be the largest tokens, right? And it gives investors the opportunity to say, I love Bitcoin, I love Ethereum. What are those next 3, 4, 5 tokens that are going to ensure that I'm continuing to have not only the beta of Bitcoin and the strength of Ethereum, but also, carrying along some of the growth that is going to exist. And that's rapidly changing. And so if you can offer an investment, I mean, the CoinDesk 5, right? You can offer an investment into a product that, essentially gives you 75 or 80% of the entirety of the crypto market. That's no different than really getting the S&P 500. It's just fewer tokens because it's a more concentrated market. And so yeah.
So I'm a little annoyed because I agree with everything the two of you have just said, but it creates a little bit of annoyance, and I want you to resolve it for me. Basically, I boil it down, everything the two of you have just said, into two simple statements. Number one, there's more to crypto than diversification.
Yeah.
Uh, and or there's more to Bitcoin, I should say. Um, you should have just more than just Bitcoin in a crypto sleeve. But second, uh, the routine metrics you may look at, such as correlation, may mislead you into the incorrect strategy. So resolve this for me. What is there a best way? How do we take what the two of you have just said and turn that into an investment strategy? How do we do this?
Please start, Dave.
No. Go ahead and start, and then I'll finish up with some product ideas.
I mean, this is what we do for a living, right? We think that market capitalization, which is basically the circulating supply of each digital asset times its price, gives you a great sense as to the power of those networks and the success of those enterprises, or as Dave puts it, those pieces of software. So market capitalization weighting not only reflects the dominance that Bitcoin has in the marketplace right now, right? Bitcoin is 2/3 of all of crypto, right? Bitcoin's 2.5 trillion, all of crypto is 3.7, 3.8 trillion. So you don't necessarily want to drift too far away from that. Yet you want to have a meaningful exposure to Ethereum and to other top tokens. So market capitalization weighting is your kind of standard, a standard way to approach this problem. We index this with the CoinDesk 5. We keep close track of circulating supply. We rebalance the index quarterly. We look for any changes in the tokens that might require intervention, but with these kind of current constituents, there aren't any. And as Dave points out, if that roster changes, the index will rebalance and pick up the new winners, right? So that's...
But that's an index. That's an index,
Yep.
Andy. That's not a fund.
It's not a fund, but I think it gives us as a benchmark, as a way to say, like, okay, this is what you would want to achieve if you wanted to launch into this beyond Bitcoin space with the most amount of traditional academic or indexing robustness.
Yeah. So we obviously have a product that tracks the CoinDesk 5. The ticker is GDLC. This product is currently trading over the counter. It's an SEC regulated product. It's quoted over the counter. You can buy and sell it in that market. We have filed for that product to be uplisted, similar to GBTC and ETHE, to be listed and traded as an exchange traded product on the New York Stock Exchange. We recently received SEC approval, for that. And we kind of hit pause for a moment because the SEC has asked to put that decision in front of a full commission vote. Obviously, those things take a little bit of time. I can't predict exactly what time that will take, but we feel pretty confident that that we'll be able to eventually get this.
But that doesn't have to stop people or slow them down from buying it today. You can buy it in your ordinary brokerage account at Schwab or wherever.
You could buy it in your brokerage account. You can put it in your IRA. It's a ticker that can be quoted and traded over the counter, and you can buy it in those self-directed markets. Absolutely.
The fund, because it's trading over the counter, has a premium discount feature.
The product is behaving as designed. I haven't looked precisely what the current discount is. It's been trading at a slight discount to its net asset value.
But that's kind of the point. Trading at a slight discount, if you're able to convert it to an ETP, that discount will disappear because ETPs trade at NAV.
ETPs do an incredibly good job of tracking the underlying net asset value on an intraday and any sort of period of time you're going to measure. So yeah.
That's one approach. Is that what you would put in the category of best? I mean, clearly, if you invest in the top 5, you're going to capture the lion's share of the market that exists in crypto. Is that sufficient, or is there what else would you say advisors ought to be considering, Dave, as consideration?
Yeah, you use the word sufficient. I would certainly say it's efficient. And when you can get the top 5 tokens by market cap, you get the top 5 tokens by market cap, and you have the ability to, kind of strip out any meme coins and strip out any stable coins. You really have a chance to, really get kind of very efficient exposure to, a broad swath of the marketplace. And again, as I said before, indexes sometimes are called passive, but they do have a rebalance schedule on them to ensure that you're not kind of missing out on anything or any kind of material movement in the market where some token or piece of software may take on tremendous relevance and then move into that top 5 slot. And you have the opportunity to kind of like, stay current without having to manage a portfolio actively on your behalf.
Is there, Andy, any other criteria for determining what is included in the top 5?
Oh, there are many. Absolutely. And just to put a number on the reach, CoinDesk 5 captures 81% of all of the millions of cryptos, right? Including the stable coins and the meme coins and the things that you wouldn't want to have in there anyway. We have a very rigorous multi-step process. We have reference rates which support the index. We have to review the exchanges and the exchange listings, right? So we don't just take prices from any exchange around the world. There is no consolidated tape for crypto. You have to take prices from individual centralized digital asset exchanges. You have to clean those prices to make sure that they're reliable. You have to review which exchanges you're taking prices from and see in which jurisdictions they're licensed. You have to eliminate tokens which you don't think are going to meet the objective of the index. As Dave pointed out, stable coins and meme coins are easy things to eliminate. You also need to screen for liquidity to make sure that these assets are going to be liquid enough to support large products. You need to review their circulating supply, which is sort of the number of tokens outstanding, and that can change very dynamically. Obviously, famously for Bitcoin, it's changing every 10 minutes, right? And then you have to review these and have a reconstitution process where you review everything, and we do that quarterly. So there are a lot of exclusions that are made because there's insufficient liquidity, because there's insufficient access for U.S. investors, because there's insufficient custody that might be useful for the kind of clients that we're going to be working with. So when all those things get done, we end up with, in the CoinDesk 5 names that have actually been relatively stable over the last several reconstitutions because they've been the leaders. I think there's a little bit of comfort in that the index isn't kind of, doesn't flip around too much. There's not a lot of noise in the constitution of CoinDesk 5. But at the same time, as Dave points out, if there's a new name that comes in that becomes super dominant, that becomes to own the narrative or find a use case or find a place in the digital asset space that becomes dominant, it will be brought into the index and it'll become a member.
And this is why I kind of find it interesting. I get, I'm sure you do as well, a lot of questions from advisors asking about individual coins.
Yes.
And my attitude, I always have the same question for them is, do you buy individual stocks? Because if you're not buying individual stocks, why would you want to buy individual coins? I mean, that's what ETFs are for. That's why we have these managed products, whether managed either via an index or managed through an active strategy, so that you don't have to do that kind of work. That's not the expertise that advisors, nor is it the kind of time advisors ought to be spending their time on. And so, just for example, Andy, give me a rundown. You mentioned correlation, how common it's used, but the potential flaws of it. What are some of the other different metrics that you'd have to look at?
Well, first I want to agree with you that look, crypto is the first asset class that started as a hobby amongst individuals and a passion, right, and a movement, right? It became a movement that grew pretty quickly. It was clear that there was a lot of sentiment here. And then it became this global markets place where there was a lot of new entrants, a lot of things to chase. There's almost, I would say, and listeners may be aware of this, right? There's almost a sense of anti-diversification and it's almost like you're taking traditional investment prudent practices and turning them upside down.
Sure.
I want more volatility, not less, and I want less diversification, not more. And why is that? Because traditionally Bitcoin has had a distribution of returns that's opposite of equities, right? Equities melt down, Bitcoin melts up. And people say, well, then I can toss away everything and I can just focus on one asset, my asset of choice, whether it's Bitcoin or Ether or Solana or XRP or some other name. And I'm just going to look for upside and just let that ride and get rich, basically. We're getting to a stage where that dynamic is changing a lot. The volatility of most big crypto assets is declining quite a bit. We're getting to the point where more people have portfolios in place. So again, we're really at the cusp. And then there's availability, right? And then there's standard benchmarks. So there are a lot of changes happening just in 2025 and just in the current quarter that's going to help those traditional indexing practices become easier to do, make more sense, and be more widely adopted. So correlation, as we mentioned before, not that great. I think you want to be able to Dave's point, take a digestible number of assets where you can really kind of have an understanding of broadly what those pieces of software are trying to do. Look at their market capitalization weight, trust that that correctly reflects the amount of demand and supply and adoption of each of those names. And that creates a really good benchmark for this time. So 10 years from now, 5 tokens might be an insufficient breadth. But for now, where many people still benchmark the entire asset class with Bitcoin, it's the right step forward to grab a handful and then market cap weight that and let that be your guide. One other point, as far as timing, Ethereum is still down on the year, but was up 77% in the second quarter. And that started, by some news stories as a big short squeeze in the hedge fund community. And then, ETF inflows started to happen. And then there's more talk about whether staking yields will be added, to certain products. It's a lot to keep track of. I think timing in crypto is just as difficult and treacherous as picking individual names. The liquidity flows can move very, very, very quickly. And even, a better reason to sort of buy the index and sit on the asset class and let things progress in their natural state at the top level.
Yeah, I would also say, what are the clients saying? We've had literally thousands of conversations with investors this year. We have dozens of people on our sales team that are constantly having conversations with clients, and the clients are saying, we're good with Bitcoin. We kind of understand Ethereum, but what if we wanted a little bit more? And so it's a natural answer to where, the investor's attention is going. And I would add a little bit of additional context to, Andy's comments about how this industry kind of started or how this asset class came to life. Unlike every other asset class that is kind of an institutional grade, thought leadership that leads to some sort of implementation, it's really barbelled at the institutional level. It's really barbelled. It's the smartest institutions in the world and the kind of most passionate, self-directed investors that are kind of compressing in the middle to this advised wealth market. Now, the advised wealth market has already understood the benefits of indexing and have already understood that if you diversify, that you're going to be able to have, a kind of risk-adjusted experience in an asset class. And so obviously, I think we would all agree that market cap weighting is the first place to go. I think I keep on using this term efficient when we're talking about GDLC or, the CoinDesk 5 exposure, which makes a lot of sense as kind of, the first step into the water. But very quickly, people are going to recognize, and investors are going to recognize, asset allocators are going to recognize, advisors are going to recognize that indexing is going to be the wave of the future for the ability for investors to kind of get diversified exposure. And so I think you're going to start to see market cap weighting. You're going to start to see momentum strategies, growth strategies, quality strategies, and then beyond those traditional finance, themes around indexes. I think the ability to start to develop some, very crypto-specific factor indexes is not that far away from our future. And all of the data is available. It's just a little complex to harness. That's why it's important that, you're partnering with Grayscale, because we have an institutional quality business that is partnering with, firms like CoinDesk that are institutional grade indexers that are getting institutional grade data to support, the construction of these high quality indexes. Listen, it's so obvious to me that we're going to head down the path of not only just the evolution of crypto being incorporated into clients' portfolios, but indexes, and indices, really starting to develop and follow some of what we've seen in the world of traditional finance.
And what I would observe is that although what you've kind of described, if we remove the word crypto and inserted equity,
sure,
you would find hundreds of asset management firms managing tens of trillions of dollars in that space, and have been doing it for 100 years. And we all know the big names. But there aren't that many equivalents in the crypto world. And what we're all observing is that the TradFi asset managers are recognizing the new level of attention, investor interest, asset flows into the crypto space, and they're jumping in on the game.
Right.
But for many of them, they have no particular expertise or experience.
That's
Uh,
correct.
and so you have to wonder, how are they building what they're building? How are they managing what they're managing? Which is why I would argue that a specialty advisor, somebody who lives, eats, and breathes a given subject, is really where you want to go for a niche like this. And so that's one of the, I think, the big claims to fame for the combination of Grayscale and CoinDesk,
Yeah.
because there aren't very many of you out there, and certainly not who are making products available to the I'll call it the everyday investment advisor and investor. I mean, sure, the ultra high net worth, the family offices, the sovereign wealth funds, they have access to stuff that us mere mortals don't. But you're making this kind of state of the art, institutional grade research and product availability that simply isn't easily found in very many other places.
Well, we've had a number of wealth management platforms come in here and want to diligence our business and diligence our products. And it's incredible to welcome them and for them to see, oh, wow, you guys look exactly like every other traditional financial firm and asset management firm that we diligence. You have a squeaky clean broker dealer. You've got a squeaky clean registered investment advisor. You've got policies and procedures. You've got compliance and governance frameworks. And we say, yeah, that we have all that. And so they're pleased to see that, which results in us being onboarded as a firm and then our products being onboarded as well. It's back to that institutional grade quality firm that we have built and our attention to detail on that front and partnering with firms that can support that. And it's just a matter of time before more and more index-based products be brought to market and investors start to incorporate more than just Bitcoin and Ethereum into their portfolios.
So we had several questions, several people asking the same question. And I'm going to premise it by building what you just said, Andy, that you have firms coming in to talk to you, the due diligence teams, the asset and risk management teams, legal and compliance teams, and they're doing due diligence on you. But that's a relatively new phenomenon, right? 10 years
Correct.
ago, you couldn't get anybody's attention.
Correct.
And that's the complaint that I hear today from many advisors across the industry who say, my firm won't let me do this. I
Right.
still can't recommend a product in crypto to my client. So here's the question that many have essentially asked. How do you persuade the CIO, the CEO, the CCO to say yes to adding this onto the platform, making it available to advisors? You encounter this all the time. What do you say?
Well, there's two things that I would say. First, it's a massive shift in the attitude that we are seeing at wealth managers as a result of a 180-degree switch in the regulatory environment. We had massive regulatory headwinds that have turned into industry tailwinds. Those industry tailwinds are leading, the kind of most innovative firms to start to onboard crypto. There will be a domino effect. These are, very competitive, very commercial, very capitalistic entities. And when the firm across the street onboards, Grayscale and, BTC and ETH and, eventually, GDLC, so does their firm, and that domino effect kind of happens. We're seeing that happen right now. I predicted it was going to be 12 to 18 months before we saw some of the big wires kind of onboard Bitcoin ETPs. I'm kind of right in that realm, and we're seeing it happen right now. So it's mostly just a matter of time. If I had an investor who was really, really pressing, or I had an advisor that was really pressing, I would just ask them to put us in contact with their diligence team. info@grayscale.com, and we'll have a conversation. It's very likely we're already having that conversation. But one of the things that has been, a bit of a thumb on the scale, so to speak, is when the advisors on that, in that wealth management, business are ringing the bell and saying, we want this. Our clients want this. We are at risk of losing assets because our clients are very interested in making allocations to digital assets. We want to be making allocations with a firm that understands it. And that can sometimes, get the gears going a little bit in the right direction. And we're obviously available to be an educational resource. It's what we do most of the time.
Andy, how much of your time are you spending in those due diligence conversations with wealth management firms?
I think that once clients or prospects understand, there's no benchmark regulation in the United States, but there is in the UK and Europe. So we are regulated under the BMR framework, which is overseen by the FCA, which is the prudential regulator in the UK.
Paul Truman, Andy, which is no small feat. That is a massive hurdle to.
I'm using my modest face on that, but
no, it
not
is
a modest achievement.
I've been the CEO of an indexing data and analytics company before. I know what it means. I know how you have to achieve that. I know the infrastructure it takes, legal, compliance, governance. It's really impressive. That's why we're partnered with CoinDesk.
Right.
Sorry, Andy, go.
No, that's fine.
You are under clubbing
hey,
that. It's a big deal.
I will never turn down the cheerleading. Take as much time as you need. Before that, adhering to IOSCO factors and compliance and things like SOC reports and things like that are usually the due diligence tests that we go through. But you can't, no matter how much money you have, you can't build a 10-year-old, right? So we've been at this for 10 years. XBX, the CoinDesk Bitcoin Price Index, started ticking once a second in November of 2014. Has been ticking once a second ever since then. And now we have dozens and dozens of multi-asset indices and roughly 10,000 single asset reference rates. So I think just like Bitcoin itself, whose network gets stronger every day that it continues to exist, so does our business. And in this young asset class, we feel that we stand up pretty well. We've also seen some traditional competitors who sort of dip in and dip out of the space. We are full-time. Crypto is our day job, and we have the voice of CoinDesk. So I think when you put all those things together, it's pretty easy for us to get in the room, and then the regulatory status and our governance process help keep us in the room.
Let's tackle some of the questions people have tossed in today. Dave, for the first one from Bud, are all of Grayscale's products passive? And talk about the pros and cons of active versus passive in the crypto space.
Yeah, certainly. The vast majority of our products are passive. We have one active product that takes a look at trying to optimize, staking rewards. That product is for accredited investors, so it's not a product that has been, listed and traded on the New York Stock Exchange like our exchange traded products, and it's not a product that is, publicly quoted over the counter. What I would say, in previous podcasts, and I think Rick, you and I have talked about this, kind of stock selection is dead, token selection is alive. But the truth of the matter is, this is something that, you really need to make sure you're partnering with an expert in the space. And, single token exposure in a kind of index-based fashion is something that meets the needs of most investors. And it's very rare that we are having people knock on our door and telling us that they need kind of, a 130, 30 active, strategy that's, market neutral. Like, it's coming, it's going to get there, but the market has not yet evolved in that fashion. The vast majority of our conversations are yes, no to Bitcoin, yes to Bitcoin. Great. I've been in Bitcoin for 6 months. What's next? Okay, great. Let's have those conversations. And people are, largely looking for an efficient exposure to a diversified basket of securities that's going to give them the broadest swath of the broader crypto market, making sure that they're remaining relevant, making sure that there's a rebalance schedule that keeps them kind of on the forefront, but not really going too far down the cap spectrum where they're really kind of impairing their risk return profile.
Yeah. One of the things that bothers me about the way that most firms and most advisors approach crypto, I don't understand where this came from, but what I find so often, tell me if you do as well, that most approach the subject when they're new as though they need to treat it differently from the way they treat everything else in their practice. And so they struggle about, I only buy stock ETFs, but when it comes to crypto, I'm going to buy individual tokens.
Yeah.
Or I'm a passive allocator, but I'm going to hire an active manager in crypto, or vice versa.
Yeah.
And what I say to them, tell me what your reaction is to this, is that you shouldn't change your practice to fit crypto. Force crypto to adapt to your practice. However you run money, there's a way you can do that in crypto. Yeah. You don't have to reinvent your firm. You don't have to retrain your staff, add a new tech stack. You don't have to reculturalize clients. It's just another asset class. and you can just add it to a diversified portfolio like you can any other asset class. It doesn't have to be that hard. What's your reaction to that, Dave?
Yeah, my first reaction is what our clients tell us when they engage with our research team is, wow, you talk to us just like our equity or our fixed income or our commodity, research analysts talk to us. And wow, how comforting is that? Well, it happens to be that we have kind of a macroeconomist that came from Goldman Sachs for 20 years, who's really passionate about crypto, who is, leading our research team. So shockingly, he knows exactly how investors want to be spoken to. Similarly, when I hear Andy, talk, he's talking about a market and an asset class the same way that people talk about, different measurements and metrics within other asset classes. So listen, it's all coming. I think Andy made reference to the consensus event and kind of more institutional feel to it. It's because there's more institutional players that are showing up because the opportunity is great and the regulatory environment is favorable and there's less risk with people kind of putting capital towards building businesses. That's in asset management, that's in indexing, that's certainly in wealth management, and that's certainly also in kind of tech infrastructure and other components of the business. So it's like, it's not going anywhere. I think, there isn't a single person who would, argue that crypto is going to go away. In fact, the people that have a tougher argument are the people that are saying it's not going to, grow exponentially.
Andy, anything to add?
That I'm a little sympathetic to advisors who kind of want to dig deeper. They're trying to add value, right? Like the other tens of trillions they manage in traditional assets, they want to try their own tilts. They want to try their factor model. They want to try, to pick sectors. I think to deliver more value to their clients, and it may feel as if they are doing something a little bit less when it comes to indexed exposure to, a top tier of digital assets. But where we are in the business, where we're just at the cusp of an efficient wrapper for this, on the cusp or on the precipice of being approved and available, it's early. I would say that a lot of that bravery and desire to add value to their clients is properly expressed in the idea that Bitcoin shouldn't be the benchmark for the entire asset class. In fact, you really should start to push and adopt a more representative group of assets to benchmark how you should be judged as an advisor. CoinDesk 5 does a great job of that, being market cap weighted and looking at the top 5 assets. So I think that there is ample value being added in that process once the tires are kicked, and advisors should help pave that way forward.
So I'm gonna ask you a question, Rick. I'm changing the roles here. So how would you have described the Bitcoin kind of ETF asset accumulation?
How would I describe it?
Yeah. Successful, not successful.
Extraordinarily successful.
Okay.
Fully predictable. I was predicting this for years when you and others were repeatedly attempting to secure approval from the SEC to launch these products into the marketplace. We knew from our own survey research into the advisory space that these were going to be extraordinarily popular. In our research, 77% of advisors were saying they were waiting for these ETFs to begin allocating for clients. And that's the basis on which I said we were going to see $150 billion in these ETFs by the end of 25, and we're clearly on pace for that.
100%.
Because we knew that the independent RIA channel, they manage $8 trillion. And if 77% of them allocate 1%, that's 150 billion in flows.
It's right there. Well, I was leading the witness. It wasn't a very risky question for me. The point is so far in the wealth management channel, I believe our data would tell us that 0.04, there's kind of a 0.04% kind of allocation to Bitcoin alone. And if it's a $30 trillion market and you get to a 1% allocation, you're looking at a $300 billion allocation, which would be whatever, at 150 billion, it's 2x more. So you're looking at 400 to 500 billion dollar ETF kind of pool of assets, and that's not even to talk about the ability for us to start bringing diversified portfolios to clients in an ETF wrapper, which has been battle tested and has clearly been the wrapper of choice to kind of get your get your
Yeah.
digital asset
And this
exposure.
is why I've been very bullish on the future price of Bitcoin and other coins by extension. I've argued that we'll see 500,000 per Bitcoin by the end of the decade. And it's the same simple math. If you take a look at the total value of all the assets in the world, it's about $800 trillion. All the stocks, bonds, real estate, gold, oil, commodities, blah, 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 even cash and comic books. You add it all up, it's $800 trillion. And if the owners of all that stuff, you, me, everybody, allocate just 1% to Bitcoin, that's $8 trillion of flows. That translates to 500,000 per Bitcoin.
Yeah.
So I think it's inevitable that we're going to see these kinds of numbers occur.
Yeah, I'm not an economist. I have never taken an economics class in my life, but I do know that if you increase the demand inputs and you control the supply, that has a net positive impact on price.
It's not complicated.
No,
It really, really isn't. And yet, to
no,
your point as to why we haven't seen the flows yet, it's because firms are slow, and not slow in a negative sense. They're
no, no, no,
deliberate. They're
no,
they're
no.
careful. That's what due diligence is.
They're doing their
So
job.
they're doing their job because the first and foremost is client protection. Second is firm reputation,
That's it.
and they are doing a methodical, careful review. And let's face it, to the point you made earlier, everybody on Wall Street loves to be second. Nobody likes to be first. But now that we do have some first movers, everyone else has no choice but to become second, third, fourth. And so it's going to be that hockey stick. It's going to be the snowball effect of an exponential growth curve. And you turn around 5 years from now, 10 years from now, everybody's going to be routinely allocating to crypto the way
Yep.
today everybody routinely allocates to tech,
Yep.
or to any other asset class or market sector. It's just, how can you not? So it's going to be really, really interesting. Um, Tim's asking a really interesting question. It's not so much, I think, an investment allocation question, more of a comprehension one. He asks, in your opinion, Dave and Andy, which token has the most utility? Andy, you want to tackle that first?
Yeah, uh, it's hard for me to not adopt the model of there's Bitcoin and non-Bitcoin, right? Because Bitcoin, I think, does a great job of one thing. It moves Bitcoin from one address to another, and that has tremendous utility with its 17-year network and its cap supply, its liquidity. I think that does a very good job, and the store of value, the macroeconomic factors. If you're on board with all those things, make a very strong case for its utility as a macro asset that's global, that's stateless, and that can be appreciated by everybody. And then you look at every or most other protocols, right? As Dave put, there are different pieces of software that have a function. All the talk, or a lot of the talk this year, has been about stablecoins. Those stablecoins need blockchains to work, right? Real world assets tokenized need blockchains to work. So I would put the second big category that people have to kind of think about as blockchain technology and how can it be used to change the way that we live. So it's a little bit hard to reconcile those two things because they're very different. Yet at the same time, they're both taking advantage of this bigger movement that blockchain assets have a growth path and can be incorporated into portfolios. So I wouldn't really put one against the other. I think that there's a very, very strong macro argument for holding Bitcoin, and there's a very, very strong argument that you don't want to bet against growth of a new technology with respect to things like blockchains or other service providers that make up the majority of the other large digital assets. So I think once you break it into those two categories, then you can start to think about which might have the most promise. When that changes into an investment perspective, you better be super careful, right? Because it's super hard to predict where the winners are going to be in the giant swell of adoption, right? The giant swell of adoption may be ultimately more important than these individual differences in growth paths of these things. So I think that the technology itself has a broad, and blockchain technology has a broad utility. How it's expressed in the different assets is fascinating to learn about, but notoriously difficult to predict.
I would also argue that simply identifying which has the best utility does
Mm.
not necessarily translate to market success.
Right.
We
Yeah, I was
The
know
gonna.
too
Betamax
often.
argument, right? Who's
Yeah,
old enough to remember the Betamax argument?
I was going to say that I think that stable coins probably have the best utility, but don't equate that to where you're going to have the best kind of performance or return
Right.
profile. And I say that because they're going to be the foundational element that allows people to kind of engage and do anything that they want in the digital world financially. And, that is, notwithstanding the fact that there's tremendous kind of bicameral support of stablecoin legislation. So you've got a stablecoin bill in the House, you've got a stablecoin bill in the Senate. Everybody seems to think that this is going to be something that's going to, receive congressional approval, which will therefore give it kind of a better, regulatory perimeter and better kind of legal framing, which will allow it to, continue to be successful. There'll be tremendous utility, but you can't buy a stablecoin and think you're going to get out performance.
Yeah. This has been a fascinating conversation, and I think really, really helpful to everybody putting a proper framework on this and giving advisors and investors alike on this conversation understanding of the access of the professionalism that exists in crypto, which I don't think we could have said when Satoshi first invented this thing. I don't think anybody really fully appreciated until listening to you, Andy, the incredible depth of talent and resources that CoinDesk is providing. And that you were working so closely with Grayscale is a testament to you both, the leaders in this industry. So I encourage you to go to both of their websites. If you go into the webinar chat here on Zoom, you'll see links to CoinDesk, to indices.coindesk.com, and of course to grayscale.com. And oh, by the way, CoinDesk just published today the article that I just wrote for CoinDesk. So you'll find that at CoinDesk's website on my new article there. This is terrific information, and I would strongly encourage you as you continue your deep dive into crypto and figuring out the way you want to allocate for clients, you take a look at the products being offered by Grayscale and supported by CoinDesk. I also want to share with you what we're doing next. You probably have heard of the new white paper that I released a couple of weeks ago, which has kind of been blowing up the internet, the death of the 60-40 glide path and why you need to have 10 to 40% of your portfolio in crypto. Kind of shocking, since most have been talking about 1 or 2 or 3% allocations. My white paper explains why. And my earlier white paper from January, the 6 myths that are preventing you from buying Bitcoin, both really good reads. The download is right there in the QR code. And in fact, next Tuesday, because we've had so much attention to this white paper over the past couple of weeks, we're going to be doing a special webinar here I'm going to recap for you the white paper. So we're going to do a live webinar on my white paper, the death of the 60-40 glide path, why your crypto allocation ought to be 10 to 40%. And it'll be a live Q&A as well, so you'll be able to ask your questions and interact with me regarding that paper. That's next Tuesday at 2 o'clock. I hope to see you there. And if you really want to become fluent in this subject, we encourage you to become certified in blockchain and digital assets, obtain your CBDA designation. This is an online self-study course with a world-class faculty. You get up to 18 CE credits. Half the course is on the tech, but the other half is on practice management, portfolio construction, the investment thesis, crypto taxation, how to talk about this with your clients in a way that they'll understand. Thousands of financial professionals have obtained their CBDA from 37 countries. We encourage you to do that as well. There's the QR code to learn more. And if you haven't yet read my Amazon #1 bestseller, The Truth About Crypto, available from your favorite bookstore. Thanks so much, gentlemen, for joining us on today's conversation. This has been really terrific. Thanks to Dave LaValle from Grayscale and Andy Baehr from CoinDesk. It's been a pleasure, gentlemen. Thanks for being with us today.
Thank you so much, Rick. Keep at it, bud.
Thank you, Rick.
Thanks, you too. Thanks, Andy.